Hey, fellow investor, this is Money Mind. My goal here is to share my knowledge about investing so we can all achieve the financial freedom or financial independence, sooner rather than later. So in Canada, up until 2018, it was kind of, you know, it was kind of a little bit difficult to invest because there was one way, actually, the easiest way to invest in stock market was through mutual fund, or a lot of people actually invest in mutual fund or individual stock. But there's a magazine, written by Danny Borolotti, which is called Canadian Couch Potato, as you can see here on this screen. Dan Borolotti has done a great job to put model portfolios, for individual investors, to make it very simple rather than just going and pick one by one, stock by stock. Like, say, for example, TD, RBC, Canadian National Railway, Apple, McDonald's. Instead of picking those individual stocks, there's a lot of costs in doing so, and there's a lot of time that you're gonna have to spend to do research. So Dan has put this model portfolio. I mean, things it's been out for a long time, since 2013 or 2014, something like that. And it was a simple thing. So it depends on your risk tolerance. He had conservative, he has cautious, he has balance, he had assertive, and he has aggressive. So you'd pick your own based on your risk tolerance, right? And then this is how it goes. Between those two, you'd pick three funds, which is a bond. Depends on your age. If you're, really young, you can put aggressive, which will be only 10% bonds, and you can have 30% Canadian stocks, total market. And you can pick international stocks, which include 50% US stocks, right? And by picking these three funds, you'd only pay this down here. These are the fee you'd pay, right? So you'd pay 0.0, 0.16, 0.15, 0.14, 0.13, 0.12. This is way cheaper than mutual fund, because if you invest your money, you give a bank, for example, to invest your money in mutual fund, you end up paying 2.12 to 3% here in Canada, right? And pretty much in the US is the same thing. Is about 2 to 3%. That's a lot of money, right? In this example, for example, balance fund, if you have $10,000, you'd only pay $14 a year, right? Versus 2.5% or 3% in $10,000, which you're gonna pay about $300, right? So now this is what we had until 2018. In February 2018, Vanguard Canada. So Vanguard is an investment firm. Of course, it's an American company, but they have a branch all over the world. And Vanguard has been out for many, many, many years, over 50 years, right? So they came up with this something called asset allocation. So what it does, actually, it just simplify. Instead of you having all these three funds, you bund all of them in one, right? And they came up with different product, and that was February 2018. This is about last year, and these are the funds you can see here. So they came up with, and if you go to website, Vanguard website, you would see asset allocation portfolio, right? And then they have conservative, which is, for people who are retired, old people, they wanna, just an income. So they have this Vanguard conservative, which is about 20% stock, and it had 80% bonds, because technically is income generating assets, right? So you'd get money from bonds rather than stock, and it's maybe a little bit less volatile, it should be less riskier. And they have another one, it's Vanguard Conservative, which is a little bit less conservative. It has 40% bonds, and it come a little bit balanced, has about 60% stock and 40% bonds. And they have a growth, So growth will be really good for someone who is in between 30 and up to 40. I think this is a really good one. I personally love this one, and I personally invest in growth, which is about 20% bonds and 80% equity, which is more stock. So the composition of this one, right, we'll see a little bit later. Or for very aggressive investor, they have 100% equity, right? So pretty much everything is an equity. So let's say you are going to pick Vanguard growth ETF portfolio, right? So now let's see what's in it. What's in that, which is called VGrow. I actually love VGrow because you have that little bit of 80% growth in stock, and you have that 20%. So that 20% will kind of balance, make your portfolio a little bit less volatile, but still volatile and still risky, right? And management fee of that one, right? It's a 0.22%. So let's say, for example, you have a $10,000, you'd pay $22 a year for you to have your portfolio managed, right? Or here they say MER, which is management expense ratio. So it's pretty much everything included, including withholding tax and everything, because this one has foreign stocks. So if you live in Canada, you invest in, for example, in Germany or something like that, it's, those Germany company, when they pay dividend, there's something called withholding tax. They'll take a little bit of money that they pay out, in taxes, which altogether will be 25. So let's say, for example, you have $10,000, that will only be $25 a year you would be paying. You have $10,000, but then you would be getting 2.75 in dividend. So, and then they say dividend schedule, which will be quarterly. So every 3 months you'll be getting. So you'll be getting dividend 4 times a year, which will be 2.75 of your money, or equal to 13 cents. It varies, these ETFs usually varies between 13 or 14. It depends, it grows. Anyways, that's the distribution. That's your income you're gonna get. So if you have $10,000, you get 2.71%, right, a year, which will be almost $300 you get from your $10,000, but you only pay 25. So that's pretty cool. And of course, that's just a dividend, right? So you take those dividends, you invest back to this fund, which will make your investment even grow, right? So if we look at the growth of $10,000, this is hypothetical, right? Growth since inception, which was 2008. $10,000 actually is 2909, right? 2019. Was it a growth? Yeah. So you would have, let's say, for example, if you invest in $10,000, will be almost $11,000. This is less than a year, actually. This is only like September 29, 2019, right? You would have that much. That's how much you're gonna have. So what this fund actually invest in, as we say, this fund is 20% bonds and 80% stock. So what do they invest in those stocks? Which countries are those stocks from? So you would have Vanguard US total stock market, right? You would have 32%. 32% of that fund will be invested in the US. You would have 24 and 1% will be invested in Canada. You would have 17% of your money will be invested in in developed world, like Australia, Europe, and all the developed countries, including Japan, I believe, except North America, because Canada and the US also developed. But because you already have Canada here, you already have US, this will only be invested in those other countries except Canada and the United States, right? And then portion of your money now. So now we already have US, we already have Canada, we already have all other world like Europe and Japan and Australia. Now there is 12.1% will be invested in Canadian bonds, and you'd have 5% will be invested in emerging market stocks. That will be China, like Brazil, Mexico, India, South Africa. That will be emerging market. Russia. 5% of your money will be invested in that, or of this fund will be invested in South America. And now you'd have Vanguard, except US aggregate bonds, 4%, and you'd have Vanguard US aggregate bond index hedged, 3%. You can see the top holding of this fund. It's Royal Bank of Canada, Toronto Dominion Bank, Microsoft Corporation, Canadian National Railways, Enbridge, Bank of Nova Scotia, Apple, Amazon, Alphabet, which is Google, TC Energy Corporation, and the list goes on. If you click on that one, you will see more of the companies that fund invest. So instead of you going, let's say, buying Apple, buying this, buying that, buy that fund includes all that, right? So that's the beauty of this one fund solution, right? And if you come down here, you'd see the distribution of the fund. You'd see distribution by credit maturity. That's the bonds, but all this information you don't, not necessarily you need to know all that stuff. So now we come to that's the list goes on, right? We say TC Energy, there's a Suncor, there's a Bank of Montreal, there's a Brookfield Asset Management, Shopify, Canadian Imperial, Bank of Commerce, there's Canadian Pacific Railways. So if you keep clicking, if you go on the website, there are going to be all that funds, all the company that company invests. So imagine if you have $10,000, you want to buy all these stocks. You got to go and research each one, which one you're going to buy. So instead of doing that, you just go in there, you just buy that one fund, and that covers everything, right? And if you don't want a bond, you can go to the other fund I mentioned earlier that invest in everything, right? And if you live in the United States, you can just go to this fund here. It's called VTI, right? United States Total Stock Market. Or you can go to another fund. It's called VT, which is US or Vanguard International Total Stock Market, right? It's right here. You would see right here, Total World Stock Market. So you can just buy this one fund that will cover everything, that include Canada, US, Europe, and the fee will only be 0.09. So let's say if you have $10,000, you're only gonna pay $9 a year. That's ridiculous cheap. Anyways, that's the growth of that fund, and you can see the top holding. It's the same: Microsoft, Apple, Amazon, Alphabet, Facebook, Berkshire Hathaway, JP Morgan Chase, Johnson Johnson, Nestle, Visa, and so on. So that's for US if you live in the United States. And if you live in Canada, you'd buy one of those, right? Either VGRO, or you can buy Total Stock, right? As we show you earlier, there's a different type of funds, right? You can just buy this one, VT, which is pretty much the same as VEQT is the same as VTI, but a little bit. The difference is that in Canada, it's a little bit management fees a little bit higher because we got 22, right? But pretty much the company that they invest, they will be the same thing. All right, that's it. You'd see, if you come to this, you'd see because this is Canadian fund, they're gonna have the first funds will be more of Canadian companies. For example, you have Royal Bank of Canada, Toronto Dominion, Microsoft, Canadian National Railway, Enbridge, Bank of Nova Scotia, Apple, we have Amazon, we have Google, Alphabet, we have TC Energy, and so on. And you can see the sector that these funds invest will be financial, be 25, industrial, technology, consumer service, consumer good, oil and gas, healthcare, basic material, utility, telecommunications, others, right? And we can see the biggest sector in this will be financial, right? That's all the banks, and we have industrial. That's your biggest manufacturer, like Boeing, Caterpillar. Would have technology, that's Apple, Microsoft. Would have consumer service, oil and gas, Chevron, healthcare, Johnson and Johnson, basic material. We have utility, and so on. And you can see the fund invest in the United States is 40%, Canada 30%, Japan is 5%, United Kingdom 3%, China is 5%. And if you want to buy these funds, you just go to one of your brokerage accounts, right? A brokerage or a bank or something like that. You open an account. For example, here in Canada, one of the cheapest is Questrade. You go in there, you can open one of your accounts. Where you want to invest in is tax-free saving account, registered account, right? You open those account, you click on it. Let's say, for example, you want to invest in registered RSP, which is a 401k or something, right? You'd click on that. You'd say open account. You'd open account. You'd have account open, or you go to your local bank and open account. And once you have the account open and you fund the account, then you can just put those ticker symbols in there, like a VQT, or you can put VTI, and you can buy that. And you'll be getting this dividend every quarter, and you take those dividends, you repurchase the same fund, and that's how your money grows bigger and bigger and bigger. So yeah, that's all I have for today. If you like this video, please subscribe, like, or comment. That will mean a lot to me, because our ultimate goal of all of us is just to want to educate, want to share, want to inspire, and make sure we retire, we achieve the financial freedom sooner than later. And the only way to do that is by being open to sharing our knowledge. So that's all. Click that like button and make sure you click the ring button or the belly button, so every time I release a video like this, you will get notification. Thank you very much for your time. Appreciate it.